Here's what's coming up on today's show.
I don't know that long-term care insurance, whatever type it is right for everybody. What I do know is that having a long-term care plan is. You don't necessarily need to go out and buy insurance, but you need to have a plan for dealing with health care in your retirement years.
This is the Retire Happy podcast with John Amarino, fiduciary financial advisor at Securus Financial in the San Diego area, and Thomas O'Connell, president of International Financial Advisory Group, Inc. in Rockaway, New Jersey. Together, they'll be keeping retirement happy from coast to coast.
Welcome back to another episode of the Retire Happy podcast. I'm your host on the West Coast, John Amarino, and I am joined by my host on the East Coast, the esteemed Tom O'Connell. Tommy, how you doing, buddy?
I'm well, John. How you doing?
Good. It's getting towards the holiday season, so got all the decorations up in the house.
Nice. And hopefully everybody's RMD letters went out. So coming towards the end of the year, your RMD's got to get done. And if you started an NUA, like we spoke about earlier in the summer, that's got to get done by the end of the year, folks. Yeah.
So matter of fact, we're doing all our RMD ledgers. We're finishing that up this week. And also Roth conversions, 'tis the season. So, now as we're getting into the holidays, a lot of family time and a lot of gifts of giving. And these last couple of months, we've talked about healthcare in retirement, and we've talked about Medicare, the skilled nursing facilities, the hospice. And now we're going to go on to the final segment, and that is how you're going to address the long-term care event. And Tommy, I know you and I have had this discussion in the past. When I ask people, do you have a long-term care plan? The first thing that comes to their mind is, oh, you're trying to pitch an insurance policy, right?
Yeah, it's one of the first things people think about because it's, again, a lot of that bad information that's out there. That's what they get talked to about. We've done one of our programs back earlier a few weeks ago with Don Graves and talking about reverse mortgages, which is an incredibly efficient way to do it as well, right? And so today I'm looking forward to this chat with Steve because people need to know that there's a better way, I guess, right?
Yeah, and folks, listen, the onus is really on you to have a plan. We talk about it all the time. I just got done teaching a couple retirement workshops, and the first thing that they taught me in my advanced designation is probably one of the most powerful comments to me is retirement is no longer about probabilities and expectations. Retirement is about defined outcomes and consequences. You can't be playing the guessing game. Yes, we have to project and we have to make some educated decisions, but I cannot think of any better issue that has the consequence of not planning. And planning just means having a strategy. If you want to do assets, if you don't want to have a long-term care insurance or you don't want to use a reverse mortgage, you can't bury your head in the sand and never think this is going to happen to you because it's 7 out of 10 people, folks. So you have to have a plan. If you're going to do assets, that's fine, but you better be parking away close to $500,000
easy
in an investment account that has to be wisely invested, and you're not going to touch it. You literally have to psychologically cordon that money off.
And you really can't take any risk with that because think about what's happened over the course of the last 12, 18 months, right? The markets are down 20, 30%. What if this were the time that you were going to go into that nursing home and start paying for it?
Yeah. And then that'll be sequence of returns risk to the nth degree, right?
Absolutely.
Taking out $100,000 when the market's down 30%. So what today we're going to talk about, you have the option, the reverse mortgage, the spending from your assets, right? Medicare's not paying for this.
Medicaid.
And Medicaid or Medi-Cal is only going to help you when you're completely broke. And as we talked about with Amanda, if you want the 4 walls, the 1 window and 4 roommates, there's Medicaid and Medi-Cal.
And your goal shouldn't be to be dirt poor broke either, right? I mean, you've worked 30, 40, 50, 60 years and you've saved and sacrificed and you've done without for all those years to put money in your pocket, to put money in your bank account, maybe to leave a legacy to your kids. So your goal shouldn't be to have nothing so the government can take care of you. Your goal should to be have a plan so that you can create a financial legacy and something for your beneficiaries to have to take care of you and to remember you by. That's just my opinion.
Yeah. And even think about it. I mean, Tommy, you're really, when I hear
I'm fired up, baby.
You're correct. But what about your spouse? You're leaving them broke.
I left that out. Yeah.
Yeah. So today is the final segment of this series, and it's really to talk about, well, we know we can self-insure, we have these other options, but what if we want to take that risk off and we want to have an insurance company either take all the risk or part of the risk? So today we have one of the industry's top experts to discuss long-term care insurance and benefits. And we're going to be talking with Steve Cain. He is a sales and business development leader with LTCI Partners. He's got 20 years of experience. He's been in the Wall Street Journal, Financial Planning, USA Today. He's a chair of several long-term care insurance groups. He's members of NAFA, FinSECA, the Society of Actuaries, which that's got to be an intriguing group to be with. Boy.
Oh, yeah.
Fascinating.
I bet you those parties are exciting.
Yeah. And he's also a former member of the Chartered Long-Term Care Board of Advisors. So without further ado, we are excited to introduce to you Mr. Steve Cain.
And today's guest, the sales and business development leader with LTCI Partners, Steve Cain.
Hey guys, thanks for having me. Again, Steve Cain here, self-described long-term care nerd, and I lead the sales and business development efforts at LTCI Partners, and we're one of the largest in the industry brokerage general agencies, and we work with advisors like John and Tom to help determine if their clients need long-term care, and if they do need the insurance, then we help them with some of the brokerage work and do the due diligence and recommend the optimal solution for these products.
Yeah, and Steve, I've used you guys on several cases. You guys have not only helped me design quality long-term care plans with that insurance segment, but you guys have also analyzed some existing policies and really helped me with some creative things like doing a 1035 exchange out of a non-qualified fixed index annuity. So you guys do a ton. I mean, from the advisory standpoint, you guys are probably one of the most sought off speaking experts in terms of webinars. All the top, mastermind groups really look to you guys.
You know what, John? You guys do it all. Like I try to keep it simple. I got one job, right? That's to stay on top of the long-term care marketplace, and that's what we do. And I think we're aligned. As you and Tom and I were talking, we're aligned in the way we look at this business. I don't know that long-term care insurance, whatever type it is right for everybody. What I do know is that having a long-term care plan is. You don't necessarily need to go out and buy insurance, but you need to have a plan for dealing with healthcare in your retirement years.
Yeah. See, folks, so you hear that from an independent voice. It's not just ours, right? It's all about the plan.
Yeah. And you guys are a major player. I mean, $400 million of in-force premium, 200,000 policyholders with over $50 billion in benefits available to policyholders. So 400 million in premium, 50 billion in benefits.
Yeah, we're having a great time. And over the years, long-term care has been an afterthought, so much so that my wife used to smack me around and saying, "Hey, Steve, why are you focused on long-term care? Just disability insurance, life insurance, annuities. Why don't you move in that direction?" And I said, "Hey, it's coming."
Yep.
hang in there with me. It's coming. And I finally feel like we're there. And why do I say that? We've got this huge demographic shift where folks like me, let's use me as the example. I'm 48. I'm dealing with my 82-year-old mom, yeah, with a long-term
Right.
care event right now. And I know you guys mentioned that you had a discussion about reverse mortgages. I'm looking at that for mom right now. My brothers and I are talking about how do we finance her care. She doesn't have insurance. And this is front of mind for me. And it's front of mind for a lot of people out there. It's not just me. So our business has been the benefactor of just a demographic shift, a heightened consciousness about this planning, and frankly, the pain that's involved with a lack of planning. And it makes folks like me in my age range want to start that planning.
We used to talk about the statistic about how many people are turning 65
Right.
every day, right? And now for the next 12 years, because I'm the last year baby boomers, 1964. So between now and for the next 12 years, you're going to see 10,000 people a day turn age 70, roughly, statistically speaking. So we're at that time now. Like you were just saying, Steve,
Yep.
This is the time. This is where guys like you, companies like yours, are stepping up and really doing an incredible service for the general public.
Thanks.
The thing I really like about your company too is that you're just not, you don't work with one company or one product, right? You guys have, because as we'll get into, this whole arena has evolved over time. So I can remember in the 1990s, there was just one type of long-term care policy, and that was it. And now it's evolved into hybrids and using life insurance, permanent life insurance, and the more traditional types of plans as well. So we'll get into that, but that's what I like. You guys figure out the right plan, and then you find the right company with the right plan for the client.
That's it. And you've got to be, objective in terms of the type of solution, and whether it's a reverse mortgage or an insurance solution or self-insuring. And then as it relates to the insurance, you've got to be neutral as far as like, what's the right solution? And you guys do a great job in terms of fact finding with your client base to determine, all right, based on what you shared with me, this one's a better fit than that one. And we help along the way as well.
Perfect. You want to start there, John?
Yeah. Let's jump into the types of long-term care there, Steve. So why don't you talk to us about what are the different types of long-term care that when advisors approach you guys, you talk about?
Yeah, well, Tom brought it up like 10 years ago, 80% of what was sold in the industry, not just with my firm, was a traditional long-term care insurance solution, pure insurance. No cash value, no return of premium, the ability for the rates to go up over time, which in many cases they did. And we had 100 different companies doing that. And for a number of reasons, but many of them were similar. All of these insurance companies that were in that business felt incredible pain. And what do I mean? I mean, they underpriced those products. They made incorrect actuarial assumptions or how they priced those products. They made some key mistakes. And every company felt it. And one after one, these companies kind of tapped out and said, I don't want to do this anymore. That's not to say that they're not paying claims and hanging around with those in-force blocks of business, but they suspended new sales. And now we've got about 10 of those companies total in that traditional marketplace. So what happened over the years? We saw an incredible growth in the combination life and long-term care world. So now we've got more options than we've ever had before. If you look at today, in terms of the distribution of sales, about 80% of all products that are sold are combining life insurance and long-term care together, and 20%, so it's kind of flipped, are the traditional long-term care solutions. There's still a good answer for many people, but it's still a small part of the market compared to the When I look at these solutions and you guys give me a call and say, hey, Steve, I've got a client that's interested in this type of planning. What do you think? We're looking at traditional long-term care. We're looking at combination life and long-term care. You're looking at annuities with long-term care as well. And with all of those, you're talking about numerous companies that play in those product lines. So you really have to understand the nuances between each product to determine what's the right fit. People always ask me, guys, hey, Steve, what's the best product? And I'm not trying to be evasive, but I say it depends.
Right.
What are we trying to accomplish? Do you
the
need
one that
life
pays the
insurance?
bill.
Yeah, well, that too. That's the best product, is the one that pays the claim on time. But beyond that, it's what are we trying to accomplish? Do you need life insurance first? Was this strictly trying to solve a long-term care problem first? Are you okay with the possibility that the premiums are going to go up each year? Do you want something fixed or guaranteed? There's a number of questions that we come back with to help determine the right solution.
Yeah, and I think kind of using a doctor's analogy, there is no easy question. Just like you said, it's a very individualized and really as long-term care has evolved, there's not even just one solution. I mean, if you looked at long-term care as like a cancer, right? A lot of people that go to oncologists, they're not just getting the surgery and they're cutting the cancer out. They might be getting surgery, radiation, or chemo, or oral pills. I've seen some scenarios where people have the opportunity to use a long-term care doubler on their annuity, and then they just supplement that with perhaps a asset-based or a life insurance type of long-term care.
Yeah, I mean, look, there's a lot of solutions out there. I'm fortunate enough to be on advisory boards of different carriers, and we're seeing product innovation. And I'm not at liberty to share which companies, but I've signed NDAs. There's going to be 2 or 3 new companies that are coming out into the combination life and long-term care space in 2023. So we're encouraged, number one, that it's finally on the radar screen. Like consumers are finally thinking about long-term care. And number two, we're going to have a more broad set of solutions to support them.
Yeah, I think we're finding people are paying more attention because they're getting smacked in the face with it, to be honest with you, right? And the people that are talking to me about it or asking me about it are the people who've already experienced that pain. So now it's something that's real to them, as opposed to something very esoteric that they heard about from their friend's friend or something along those lines, right?
Yeah, Tom, I think I've always thought that this is an event-triggered issue.
Yep.
Right. That event could be my 82-year-old mom that I mentioned. It could be your kids that have graduated college or got their first job and they're off the payroll. It could be a birthday. It could be your own health event. But there's something that triggers a decision point when it comes to long-term care.
Yeah, totally. I've been around long enough to remember these older policies, like you were saying, Steve, where there's no guarantee in premiums, that they priced them wrong, that they were very rich in benefits for a really low price. And now all of a sudden people are either seeing their benefits decreased or the premiums increased or a combination of those. So I know I'm sure with John, my experience lately has been really in the permanent life insurance world, and with the utilization of annuities along, and also the reverse mortgage. So maybe give us a little bit of an idea about how those products are just a little bit different than the more traditional plans that people have seen or gotten in the past.
Sure. Let me start with traditional for a second. If you're listening to this and you own a private, individual, traditional long-term care insurance policy, just know that the industry is paying $12 billion a year in claims. That piece of it is working. Also, spirit of full disclosure, you're likely going to be faced with, if you haven't already, a rate increase. And overwhelmingly, most people hang on to these policies, even if they're faced with rate increases. And what they do is they either gulp and pay the entire increase and maintain the benefits that they purchased originally, or what all of these carriers are giving clients the opportunity to do is dial down the benefits a little bit, because maybe they overinsured or maybe they bought a really robust benefit, and you just dial down the benefits a little bit to make sure it's meaningful. And that might be able to mitigate the entire increase or a big portion of the increase. So just want to give a tip there. As it relates to the other solutions that are available, I don't know about you guys, but I like guarantees, right?
Sure.
If I don't need long-term care for, or don't think I'm going to need it for 20, 30 years, I like to know what my premium is going to be today and what it's going to be 15 years from now or 20 years from now. And that's the beauty of these asset-based long-term care plans, these combination life and long-term care plans, that it is a guaranteed premium. And also we've got guaranteed benefit. And that seems to resonate with a lot of clients out there. Now, of course, going to be a little bit more expensive than the traditional plan because there's return of premium involved. There's premium guarantees, but a lot of clients, frankly, clients have spoken. We're seeing 80% of the insurance industry's production going that way. So whether it's with an annuity that has a long-term care benefit or a permanent life insurance that has a long-term care benefit, we seem to see those being what's most purchased today.
Yeah, and
I
think going back to the 80%, the shift, my 20% of clients, and I have had some clients that preferred the traditional, and those were clients that had parents in long-term care facilities. But I think the 80% really goes back to the people who have never experienced in their family a long-term care event, or the people whose parents paid into long-term care all these years and they never got the use of it. So they really like the availability of that. You if you don't use it, okay, now there's a tax-free death benefit attached to it, and that guaranteed premium, that level premium. There's no surprises, and from an advisory standpoint, it's much easier to build in as part of their spending plan.
It's just hard. Like, think about it psychologically. We're not wired to think about risk 30 years from now, and
Right.
so it's really hard for us to think about paying in a premium for 30 some odd years that I might or might not use, number one, or a policy that I might or might not use, and number two, for the premiums to likely go up over time. So, I just like the certainty with those combination plans.
Sure, and you can design them any way you want, right? You can create a single premium. You can create one that's paid over 5 or 10 years. It's all, we've talked about life insurance on a couple occasions here, and it's all about how you design it. So it's about having your plan in place and understanding what you can and can't do, or what you want to or don't want to do, right? And then designing the right plan. And that's why we turn to guys like Steve to help us be able to do that in the most efficient manner for our clients.
And guys, one thing that I'm asked all the time is like, how do you design a plan? And just want to share with you, you don't have to be the long-term care nerd like I am to understand how this stuff works. I really think there's, 4 key components, 3 or 4 key components to all of these plans. Whether I'm talking about traditional long-term care, asset-based, permanent life with a rider, it really comes down to, number one key component: what do I get when I need this stuff? What's my monthly benefit for long-term care support and services? Whether I'm at home, assisted living, skilled nursing, what is the insurance company going to pay me each month as I need this care? Second key component is, how long is this stuff going to last? What's the pool of dollars that I have available to me that I can dip into for these types of services? The third key component is, what do my benefits grow in value to over time? We're living in high inflation right now, but the inflation on the cost of long-term care services is continuing to go up. For a long time, it kind of had steady inflation on it. Now we're seeing bigger spikes, and I foresee it's a supply and demand issue where there's a shortage of caregivers today, and we're going to see these agencies and facilities charge whatever they want because of that supply and demand imbalance. So third key component is inflation protection. How do I make sure the policy benefits are growing in value over time so that when I need this when I'm 84, this policy is actually going to be worth something? And then the fourth key component is, do I want my money back? Do I want that life insurance component with it? Or how do I want to pay for it? I kind of wrap that into the fourth key component. But really, if you understand these 3 things, you understand long-term care. How much do I get when I need this stuff? How long is it going to last? And how do my benefits increase in value over time? If you understand that, you get long-term care.
Perfect. Yeah, those are definitely key. So if it's okay with you, Steve and Tommy, I love how you just broke that down, Steve. And I would like to just spend a couple minutes talking about how some of the conversations you have with advisors, because obviously you mentioned benefits, how long they last, right? There's inflation riders. And I want to really kind of give some clarity to the audience, like, hey, what's overkill? What are the benefits that you're kind of seeing the trend to? And, do you need lifetime benefits, or maybe choose the 60-month option? So let's start off with the benefits. Like, what are the trends do you see, and where do you think, if someone wants a lifetime benefit, what may be a circumstance? Like, is that for more people that are scared for Alzheimer's or something like that?
Yeah, I would say, like, who typically buys a long-term care benefit that's lifetime? Somebody that has a history of Alzheimer's in the family, number one. Somebody that went through or personally experienced a long event with a loved one. Those are the people. But conversely, if we look at the data, like actually how much care people need, I think over the years we overinsured people. I'm pointing the finger at myself and advisors out there. We were trying to totally transfer the risk with insurance, and we did. But when we look at data today, we're seeing that women need care, long-term care support and services, for about 3.7 years, and men need care for about 2.2 years. So I'm going back to advisors and clients today and saying, hey, do we necessarily need to transfer all of the risk, or do we hedge? And given the environment that we're in today with high inflation and gas prices out here in California, a looming recession, hedging might be the answer, guys. I'm not necessarily saying you need to totally transfer the risk these days. So if I look to my own business, and you mentioned earlier, we do a lot of transactions with a lot of advisors over the years. We're finding that people aren't seeking perfection, right? My old mentor used to tell me, don't let perfect be the enemy of good.
Right.
In my scenario right now with my mom, I mentioned we're looking at a reverse mortgage because mom doesn't have insurance. My brothers and I are out of pocket funding this care event. And so we're looking at it saying, man, if I had helped her plan earlier, and maybe we didn't have $4,500 a month of benefit that it costs right now, but what if we had a benefit that cost $3,000 that paid out $3,000 a month? I would have been thrilled. That means
Right.
I would only have to, come up with that $1,500 a month divided by 3.
Right.
So I'm a big fan of hedging.
Yeah. And kind of as you were saying that, I'm jotting down my own planning notes. Okay, hey, here's the plan. We're going to do this. And if we go beyond, if you're that statistical anomaly that goes 4 or 5 years, well, then, we're going to either go towards assets or the reverse mortgage option. Again, we're hedging, like you said.
Or again, we go back to the Medicaid planning too, right? So you have your 5-year window of opportunity to give stuff away. So people can do the old half loaf theory and get some assets out during that period of time for their kids. And I'm not saying Medicaid is the answer. I'm not saying that. But what I'm saying is, look, even by going half measures, you have an opportunity to be able to not have the government take everything away from you.
Yeah. Yeah. So we were talking about, obviously the duration. I think that's a big area where people, as you say, get overinsured. What about the inflation rider, especially now, double-digit inflation everywhere? You'll see some of these policies where, people were 5%, 5% inflation. Where do you think is a suitable over the trends compounding?
I think 3% is the new normal. I think the majority of the industry sales right now are to 3% inflation. That's not to say we don't have carriers that have 2 or 1% inflation components. If you're going to go lower than 3%, what I would suggest is start with a higher monthly or daily benefit amount, kind of overinsure yourself on that end, so that the 1% takes longer to catch up in terms of the growth. But if you were to ask me today, hey, what do you recommend with most clients? It's probably that 3% compound. And then when we're dealing with older clients, sometimes we do no inflation protection whatsoever. So let's say it's a 72-year-old client that's concerned about long-term care. It's not too late at that point. Let's say this client was healthy enough to get coverage. Maybe we say no inflation, but we gross up the monthly benefit so that they have more monthly benefit, taking into account that their policy is not growing.
Right.
So there's some creative ways to do this.
So the old traditional way of making those payments too was for mostly skilled care. Nowadays, if I understand it correctly, nowadays with the life insurance and the annuities, it's more of a cost redemption, right? So like you and your brothers could technically, I guess, get paid for helping your mom out.
Yeah, I mean, there are plans out there that pay the policy benefits in an indemnity or cash benefit payment. That means once mom is claim eligible, they just cut a check and that check could come to the trust or to the brothers, and we divide it up and do as we see fit. But I love that flexibility with some of those plans that are out there, and that's called an indemnity or cash benefit payment. And so you've got that flexibility. And you mentioned the care setting. I think it's really important for people to understand that this is not just about skilled nursing care. About 70% of all claims stop and start at home.
Mm-hmm.
So when you're thinking about long-term care planning, this is about home health care.
Mm-hmm.
This is about assisted living, those high-end, 1 or 2 bedroom bathroom apartments where you have a button on the side of the wall that you go press when you need assistance. And then worst case scenario, maybe towards the end of your life, then you have the skilled nursing care component as well.
Yeah.
Right. That was one of the great evolutions of these types of policies too, because we'll go back, if we go back to the cost for a second, here in Jersey, it's $10,000 to $12,000 a month for a nursing home. And that's not where anybody wants to be. That's not what anybody wants their end of life legacy to be. So when they started bringing on the home health care part of it, and then the indemnity part of these programs, for me, these policies have just evolved into something that, honestly, if you can get it, nobody should be without it at this stage.
Yeah. And you mentioned the qualifications for it. Steve, would you what triggers the insurance company stepping in and paying out the benefits?
Yeah, well, I'll start with overwhelmingly. Like, first of all, we all have a knee-jerk reaction when we hear the word claims. Maybe it's our we think about medical claims where we're arguing with doctors about, in your insurance company, about what's covered and what's not. Overwhelmingly, the insurance companies are paying out claims. Why? Because it's black and white. This is standard industry language on all of the policies, whether I'm talking about a traditional long-term care policy or the asset-based. If I'm unable to perform 2 out of 6 of my activities of daily living for a period of 90 days or more, or the other way to qualify is if I have a severe cognitive impairment, something like Alzheimer's or dementia, then I would receive long-term care benefit. So again, if I'm unable to perform my regular everyday activities, bathing, dressing, eating, toileting, transferring, continence, 2 out of 6 of those, or if I have a severe cognitive impairment, something like Alzheimer's or dementia, then I would qualify for benefits. And overwhelmingly, when somebody files a claim, they're getting benefits.
Yeah. And so as these benefits are going, obviously a big part of long-term care planning is to take the stress off the family. It's something that Tommy and I have talked about often, about healthcare directives in a trust, right? Take that decision making, take the stress off the family and give them options. And one of my favorite things that I'm seeing, as you guys have discussed the evolution of these, is the joint policies where a husband and wife, have a policy together. And if the one spouse doesn't end up using it, then the benefits transfer over to, the living spouse.
Right. We love those. Right now, there's one company doing that, and we expect more to follow suit, but we're big fans of those.
So, Steve, for our listeners, what we've kind of talked about those 4 benefits, but what are some red flags that they have to worry about, right? I mean, listen, every industry has unscrupulous salespeople or companies. What really do they have to understand that their insurance company, whether it's a financial rating or whether they're being sold a premium for a high commission product?
Yeah. We all have to be informed consumers, right? And it starts with the advisor that I'm working with, to ensure that this person has my best interest, first and foremost at heart. And then beyond that, as you look to these insurance solutions, I want to make sure that it's a company that's been in this business, that's committed to this line of business, because potentially they're not going to pay out a claim for 20, 30 years, so I need to make sure that they're pricing it the right way. So what do I look to? I look to their financial ratings. I look to how they underwrite these policies. I look to the the benefit triggers, like I mentioned, some of the contracts out there require a permanent disability in order for you to qualify for benefits. That's important. So I'm always looking at, hey, is this 2 out of 6 activities of daily living or a cognitive impairment, or does this one have a permanent disability clause in it? That's important to understand. And then going back to the agent for a second, did the agent talk to me, or did the advisor talk to me about my strategy as it relates to this? It's not a one size fits all with the different types of products, but also the plan design. Did we talk about transferring the risk, or did we talk about hedging? Did we talk about lifetime benefits, or did we talk about, doing something that more closely aligns to the statistics of the 3-point-something years or the 2 years, like I just mentioned? So I think those are some of the things that I would look for as I'm going through the due diligence process. And ultimately, I just think you got 2 ways to do this. Ultimately, I know you guys talked about reverse mortgages. I'm lopping this in there. When it comes to planning for long-term care, you either buy insurance or you self-insure.
Right.
I'm considering the reverse mortgage angle as self-insuring, or you buy insurance. It's that simple. And if I'm looking to buy insurance, then it comes down to, all right, let's look at my budget. What do I want to protect? How do I want to pay for this? The fact finding that you guys are doing with respect to what are we trying to solve, a life insurance problem, a long-term care problem, how do we want to pay for it? That then dictates what solutions we look to. And then as a consumer, I just want to make sure that, hey, you've looked at a few solutions for me, and this is the best one.
Yeah.
Or a
really.
combination of, right?
Yeah.
So
yeah.
And again, it's like Tommy and I have always said, it's even as your advisor, our job is in the word. It's to advise you. It's not to make your decisions for you, whether that's, tax planning or whatnot. You're the one that has to pay the long-term care insurance premium. You're the one that's going to be, potentially in the nursing home or your spouse. So you're the one that, if you chose to self-insure, are going to have to be okay with withdrawing, be it $5,000 to $10,000 a month to pay for this. So, I think that's a great point. And, the other thing that an interesting segment I heard during one of my tax masterminds was, just because you get one of these hybrid policies, even in itself, don't think of it as the end all be all. So the discussion I was having was, the conference leader was saying, hey, long-term care riders and life insurance are becoming increasingly popular because of all those benefits you said, right? If you don't use it, you still have some type of benefit, the level premiums. But he said, but think about it this way, just because you have that rider doesn't mean you actually have to use it. And the scenario he gave was someone that is in real bad shape and may not actually even survive the long-term care, the skilled nursing. And my wife being in skilled nursing, listen, they have, unfortunately, a lot of casualties that, never leave the assisted living facilities and go home, right? They end up dying. So the scenario is, and this is the point I'm trying to make, is that this, even once you have it planned, it's not stagnant, that everything evolves, because you may have that long-term care waiver, and that's a tax-free benefit. Maybe the better option would be to talk to your advisor and say, hey, listen, my spouse isn't going to make it, or dad's not going to make it. Why don't we spend down some of our assets and the taxable assets that we'll get a medical expense deduction for on the taxes, and save the waiver for the tax-free death benefit? And, it kind of just goes back into always having a plan for the future. And, Steve, I really appreciate the phenomenal advice and information you've given us.
Oh, happy to help, guys. And I just tell people that, again, you don't necessarily need to buy long-term care insurance, but you got to have a plan for long-term care. And November is Long-Term Care Awareness Month.
Right.
We're going to be getting together with our families. I don't know about you guys, but invariably we start talking about what medical issues or ailments family members have as we see them. And it just gets people thinking about planning for long-term care.
Yeah, this can't be a closet issue anymore, right? I mean, this is something that has to be out there we all have to be concerned about it because, it's our moms, our dads, our spouses, our brothers and sisters, our grandparents. It's people that we care and love about. So this is stuff that just can't be hidden away anymore because it's that catastrophic that we have to deal with it before it happens.
Yeah. And Tommy, add on, these are our clients, the people,
right,
that trust us, that we love. We want, what's best for them. So folks, if you have any questions about long-term care and really how to put it into your plan, give Tommy or I a call. We really thank Steve for all your education, your expertise, and really, Steve, honestly, what you do for us advisors, because I know you're a former minor league ball player. The pitcher can't just, catch every fly ball, ground ball. You need other people with skilled positions to come in and be able to add tremendous value. So I appreciate you taking time out of your busy schedule. And, Tommy, another great show.
Absolutely. Thanks, Steve. Really appreciate
Thanks, guys.
your time.
All right. Take care.
Hope your family has a great Thanksgiving.
Likewise.
Thanks.
Happy Thanksgiving, Steve. So, folks, that's going to wrap up our retirement healthcare series, but that also wraps up another episode of the Retire Happy podcast. We're getting into the holidays. We're going to have just a few more episodes in between the holidays before we wrap it up. And, in the future, Tommy and I are going to talk about some new and exciting things that we have going on for 2023. But
can you believe it's already been almost a year since we started this together?
Yeah.
This year has gone by like crazy.
It is. It has gone by. Life's gone by. I can't even believe that, 30 days from now, Jake's going to be 10. So that's the thing. And I think, Tommy, when it comes to long-term care, people often, that's, and even in my own practice in the past, it's kind of been one of those satellite types of planning, right? We've always taken care of the big core three: income, taxes, and investments. And then you kind of find yourself just, asking your clients each year, hey, we need to plan for this. We need to plan for this. And,
right.
And I don't know about you. I'm being more aggressive about it.
I talk about it all the time now. And, especially with people that are coming to me new, I'm always asking, okay, do you have long-term care? Is this an issue for you? Do you have a will? Do you have life insurance? How did all these things work? So for me, it's part of the initiation process that I go through when people want me to work for them.
Yeah. So, folks, that wraps it up. From me on the West Coast.
And me on the East Coast.
We wish you a happy Thanksgiving. We hope with all the chaos of the past couple of years that you get to really sit down, enjoy time with your loved ones, have some good food, put on 10 pounds, and
not wear a mask.
All right, folks. So happy Thanksgiving from the Retire Happy podcast. Until next time, relax, have peace of mind, and retire happy. Take care.
It's easy to get in touch with John and Thomas. If you're more on the West Coast, give John a call at 858-935-6210. That's 858-935-6210, or go online to GoSecurus.com. That's GoSecurus.com. If you're more of an East Coaster, then call Thomas, 973-394-0623. That's 973-394-0623, and online at internationalfinancial.com. That's internationalfinancial.com. And you can, of course, always just check the description or the show notes section of today's show for all that contact information. Don't forget to subscribe on your favorite podcasting apps, and we'll see you next time on the Retire Happy Podcast.
Investment advisory services offered through Brookstone Capital Management, LLC BCM, a registered investment advisor. BCM, Securus Financial, and International Financial Advisory Group are independent of each other. Insurance products and services are not offered through BCM, but are offered and sold through individually licensed and appointed agents. The opinions expressed by John Iamarino, Thomas O'Connell, and guests on this show are their own and are based upon information considered reliable, although it should not be relied upon as such. Any statements or opinions are subject to change without notice. Investments involve risk and, unless otherwise stated, are not guaranteed. Past performance cannot not be used as an indicator to determine future results. Any strategies mentioned may not be suitable for everyone. Information expressed does not take into account your specific situation or objectives and is not intended as recommendations appropriate for you. Before acting on any information mentioned, please consult with a qualified tax or investment advisor to determine if it is suitable for your specific situation. This program is designed to provide accurate and authoritative information with regard to the subjects covered.